So now we're to market value type ratios. So we have the PE ratio and the market to book ratio. So the PE ratio is just price per share divided by earnings per share. And so you get 12. And then the market to book ratio is just the market price per share divided by the book value per share. And so for the book value per share, you need to go to the balance sheet and look for the book value for 2015 of 1.9 million and divide it by the number of shares outstanding, and that gives you book value per share. And so you can see over time the PE ratio is less than the industry average, 12 versus 14.2, and the market to book ratio is also less than the industry average, 1.56 versus 2.4. Now, since we know that a lot of the information for the company was kind of bad from their balance sheet and income statement, we can say that these ratios, are not necessarily the best. Now, it's up to people's preferences as to whether they would think a 12 PE ratio is better than a 14.2 PE ratio. Some people particularly invest in low PE ratio stocks because they feel like they are paying less per dollars of earnings per share for a low PE ratio stock. And that's typically the strategy of Warren Buffett is he likes to buy so-called more of the value type firms, and he wants to buy things for cheaper than other people could. Now he probably looks at a lot of other factors and he wouldn't necessarily invest in this company, but just keep in mind that the PE ratio being high versus being low, you can't really make a total complete statement about which one is better, because some people have preferences for high PE and some have preferences for low PE. And then here's some definitions like how you could think about the PE ratio and the market to book ratio. Now they say the higher the number the better, but again, like I had a strategy with my own stock portfolio where I invested in low PE ratio stocks and I avoided high PE ratio stocks. And I didn't want to pay a lot for earnings per share. So when you have expected high growth, you can have a high PE ratio. Back to this slide. For this chapter though, since the book is saying the higher the number the better, then if you have questions for this chapter and it asks for this, then go with the fact that the higher the number the better. The DuPont equation allows us to break down the return on equity into three components that are really multiplied together. And so we can kind of see how we're doing on profit margin, which would help us focus on expense control. Asset utilization would be the total assets turnover. And then the equity multiplier, we haven't looked at that one yet, but would help us figure out how we're doing on our debt utilization. The equity multiplier, as you can see, is total assets divided by equity. So if you multiplied all of these together, you can see that sales would cancel out and then total assets would cancel out, and you would be left with net income divided by equity. So this is just another way to write it. And so if we looked at the estimate for 2015, you can see that they are estimated to have an ROE of 13%, which is less than our ROE for the industry, which is 18.2. So they're not doing as well. And we could compare across these three different categories to see where they're not doing as well. Well, they're doing slightly better in terms of profit margin because they have 3.6% profit margin. But total assets turnover, they're doing much worse, 2 versus 2.6. And then for the equity multiplier, they're also doing worse, 1.79 versus 2. And that's just because the industry, if you remember, it was using more debt, it had a higher debt to total capital ratio than did this De Leon company. And they would have a better return on equity if they decrease their inventory and decrease their accounts receivable by making their day sales outstanding go to a lower number closer to 30. And then if they did that, they could probably get to an ROE that would be much better and it would improve some of their other ratios. So this is a nice way to compare how a company is doing over time. You can look at their profit margin and these different ratios. You can see that obviously 2014 they had an equity multiplier of 5.8 because they had so much debt relative to equity. And then it went down to much less than it had been before because then they had so much equity relative to debt. So it's useful to compare across time for a company and to compare it to the industry, just like all the other ratios.